Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
This leads to another big question, and not that we're going to get to this today, but if the U.S. consumer doesn't rebound, how are Japanese exports going to rebound, and how are German exports going to rebound in any significant way? And that's the several trillion-dollar question. And part of the reason I think we see we're in the policy change that we're in terms of the current administration of what they're doing, which I think is a major mistake, but we'll get to that in a second. But what they're doing is trying to revive this symbiotic relationship and pump up other economies around the world, even more so than the U.S. But as I said, I'll get to that in just a second, and some of those implications. And let's take a look at China. This is a pretty good example. If you don't know, China's currency is actually pegged to the U.S. dollar at a specific rate that China chooses. So when the U.S. dollar falls in value, the Chinese currency relative to other world currency falls in value. It stays steady against the U.S. dollar. So if one of our concerns is rebalancing the deficit against China and using the currency to do it, and they're a big believer that the currency is the problem here in terms of just a simple trade relationship, then we should have been pushing much, much harder to get China to let their currency float. What is happening is China, because of the fact that their currency is so tightly tied to the U.S. Dollar, it's actually creating a magnet for capital flow into China. If the U.S. dollar falls faster and faster, and people think it's going to continue to fall faster, and the relative wage rates in China are so much cheaper, and the production capacity is improving in the fact that Chinese want more production, and you can create a manufacturing base there with relatively low labor rates and increasing quality of world-class infrastructure, the tie of the currency to the U.S. dollar is sucking the capital into China and away from the U.S. economy. So from a couple of reasons, China's undervaluation of their currency plays a big role in this. I think you're going to see that this problem will continue to fester, and that's why we're starting to see some real trade tensions develop, like with China, not only in the U.S. but also in Europe. The question is, are we going to see a big enough rebound in the global economy to stave off this situation? Despite what the U.S. administration is doing, labor plays a big role in U.S. policy here because they've been big contributors to the Obama administration and a big part of why he won the election. Again, I don't want to get into the politics of this per se, but that is the politics that are driving some of the export policy here. If they get very, very more forceful here, meaning if the U.S. jobs market doesn't improve, they will get more forceful, and we'll see more and more trade tensions develop. And the reality is, because China stops our goods at the border, there's a very, very good case for the U.S. to increasingly file World Trade Organization complaints against China. That, again, makes China more belligerent. So this whole thing, can spiral out of control. But needless to say, the point is here that you can see that even though the U.S. dollar went down, it did nothing to decrease the huge move in Chinese exports to the U.S. And part of that is because it's pegged, but part of it is because of the other complications with our relationship with China. So maybe the question is, maybe it's not about trade, and I think it. And I don't think it's about trade when I say trade, about exports and imports in terms of currency values. At this stage, it's very much about money flow. And this is a chart showing some correlations, and just to show you how tight the correlations are here. What we have on this chart, the red line is the U.S. dollar index, as you can see, moving from 2006 onward here. This is a more closer in view of what we've talked about. The black line is the emerging market stock index. The blue line is commodities. And as you can see, if you look, starting from the upper left of this chart, as the U.S. dollar index is going down, 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 and it's been doing this since 2002. If this chart went back to 2002, you'd see this same relationship as the U.S. dollar comes all the way down into 2008. The other asset markets are going up, up, up. And this goes to the idea that at this point, and again, you saw this acceleration from 2003 on, even in these correlations, that U.S. dollar-based credit being pumped out there to fund the globe, and all these derivatives created with U.S. dollar-based credit have led to a massive supply of dollars out there. And why the dollar bounced from 2008 in 2008 during the credit crunch is there was a massive demand for dollar-based credit out there because of all the, tangled relationships of derivatives, and that massive demand for U.S. dollar credit at a time when U.S. dollar-based credit was coming out of the market, when hedge funds were deleveraging and pension funds and corporations were coming back to hide in the U.S. The U.S. dollar moved tremendously. Supply of U.S. dollars came out of the market when demand for U.S. dollar-based credit was soaring at the same time. As that happened, as you can see, the tight correlation, stock markets came down and the commodities index came down at the same time. Sure enough, the dollar tops in here as we start to see so-called global healing in the credit markets, loosening it up thanks to the Fed pumping out money all over the world and basically saving the financial system with all their credit lines that they made available to all the other central banks around the world. Otherwise, the global system really may have tanked. But because of that, we started to see global healing, and sure enough, the dollar started down on cue, as you can see in that green area. So as the dollar starts down again and the credit markets ease, and we see quantitative easing from the Fed buying all the Treasury bonds, pushing more and more dollar-based credit again out there into the globe, what did we see happen? We saw a rebound in the risky asset classes, commodities, stock markets started to rebound in a big way at the expense of the U.S. dollar. So it suggests that, again, that this move, and I especially think in this case, it was the case before, but not as much in this case, that this move in financial assets and risky asset classes is almost part and parcel to this massive amount of dollar-based credit being pushed out there in a big way, even though we haven't seen a big rebound in the global economy to support this. And again, just go back to these charts of Japanese exports and German exports. They've not rebounded to suggest the demand is there in the global economy. So it makes the case that this big run-up in financial markets, and they've gone up a lot even since I've put this chart on here, is very much liquidity-driven. And liquidity-driven it was. This is an example, right? This is an interesting chart right here. It's called swap agreements and the U.S. dollar index. Not that you need to know what swap agreements are, and I'm sure no expert on global derivatives. But what happened as we came into the credit crunch, the red line on here is the U.S. dollar index, and this blue line here is just the value of swap agreements. There are several more zeros on the end of those numbers on the left, which relate to swap agreements that were created by the Fed for other central banks around the world to keep them from going under, keep the particular banks in their own countries from going under in a very, very big way.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.